I am not a CPA, and this is not tax advice. I am a surgeon sharing experience I learned the hard way over many years, learning a system that was not built for people who think in a scalpel instead of spreadsheet. I had to learn the language, the technical wording, and the rules from scratch. Trust me, it was not easy. If all you do is rely on tax filing, you're already losing. This talk is about strategy and why real estate changes the entire tax game for surgeons. Surgeons don't have a tax problem, they have a structure problem. You can earn more, work harder, hire better CPAs, and still lose the same percentage every year. And once you understand what happens, everything else clicks. CPAs protect you. They file correctly, they reduce risk, but CPAs work inside a system they did not design. And that limitation matters more than most surgeons realize. A CPA can optimize timing, find deductions, apply credits, but at the end of the day, your income is still classified the same way. A CPA can slow the bleeding, they cannot stop the wound. And that's why surgeons feel punished for success. So why surgeons are taxed the hardest? Surgeons can earn is predictable, visible income. W-2 or 1099, it does not matter. Few write-offs, top tax brackets. The better you do clinically, the more exposed your income becomes financially. So the real question is not how to deduct more, it's how the tax code treats different type of income. This is huge. So what real estate does differently? Real estate does not just reduce taxes. It changes how income is classified. Let me say it again. It changes how income is classified. It allows depreciation, cost segregation, deferred taxation, equity growth while showing losses. You can legally show a loss while your net worth grows. But depreciation only matters if you are allowed to use it. Here comes the gatekeeper rule. Depreciation is powerful, but only if the IRS lets you touch it. That's where the gatekeepers come in. Material participation, real estate professional status, short-term rental rules. Depreciation does not matter if the IRS locks it away. And this is where most W-2 surgeons think they are excluded, but they are not. Numbers do not lie. Let me give you an example of the short-term advantage, real numbers. So let's take two surgeons, same income. Both surgeons, let's say they make $500,000 W-2. Same CPA, same tax brackets. Surgeon A, no real estate. So the income is $500,000. CPA deduction is 50,000. So the taxable income is 450,000. So taxes would be around 180,000. This is where most surgeons live, unfortunately. Nothing wrong, but nowhere to hide. Let's talk about Surgeon B. Surgeon B is using the short-term rental owner. Buys one short-term rental, rented for 10-15 days. He will meet material participation, uses cost segregation. So paper loss, depreciation can be easily $120,000. Reality, cash flow, flat or positive, doesn't really matter that much, but property is performing. So for the tax, 500,000 income, $120,000 short-term rental loss, taxable income magically become 380, and the tax will be 140. What's the result? Same income, same CPA, one decision, tax saving $40,000 in 1 year. The property did not lose money. The IRS says it did. That's the magic. And this is why structures beat deductions. Remember, structure beats deduction. An LLC alone is not a strategy. Real efficiency comes from entity stacking, separating operations from ownership, isolating risk, directing income intentionally. Structure beats deductions every time. And over time, that advantage compounds. So let me tell you another magic. When a spouse changes the equation, if a surgeon's partner qualify for what we call it real estate professional, losses from all real estate they own, not just short-term rental, can legally offset the W-2 or the 1099 income. That's extremely powerful, but it's not easy. It requires real hours, real documentation, and real commitment. Contrast, that's why most surgeons never qualify this way. So short-term rental are different. They offer access without requiring your spouse to change their life. And that brings us to the long game. The end game most people miss. This is not just tax deferral with a 1031 exchange, long-term appreciation set up in basis. Taxes are often never paid at all. Not deferred, not delayed, erased legally. So why don't every surgeon do this? Obvious question. The education gap. No one teaches this in training. Hospitals, they don't benefit from independent doctors. Most advisors are not paid to redesign your life. The system prefers you employed, tired, full taxable, and that's why execution matters. This is powerful, and power requires precision. Bad cost segregation, poor documentation, wrong advisors. This only works when done cleanly and conservatively. This isn't about real estate. This is not about buildings. It's about control. Why? Because if you don't control your tax structure, your income will always work harder for the government than it does for your family. And if you believe healthcare in America needs to change, hit follow.